Thanks for tuning in, ladies and gentlemen. This week's a bit special. This week is, it's all about the US election. If you're watching this on Monday when it's launched, then the US election is tomorrow, Tuesday, the 3rd of November. And who better to talk you through the potential outcomes, the ramifications, all of the really important stuff than Hugh Gimber, Global Market Strategist of JP Morgan. So Hugh, thank you very much for coming in and spending some time with us today. Let's get cracked straight off. What's JPM's base case?
Well, first answer is we don't have one, because basically one of our key messages for clients is don't spend too much time trying to predict the election outcome. We know how uncertain these events can be. We have plenty of good recent events that tell us going into any of these kind of very binary events with too much confidence in one single outcome is a fairly risky business. Mm-hmm. So point number one is don't get too carried away in trying to call what's going to happen. Do the homework in terms of thinking through those different implications of the various outcomes that we see. Mm-hmm. That being said, if you look at the polls today, you have to say that the Democrats were running into this election with pretty strong momentum. And so based on what the polls are showing for the presidential race, for the House, for the Senate, national level, state level, you name it, it looks like the Democrats are in a fairly strong position. And so I think it's fair to say that the polls' most likely outcome is a Democrat clean sweep. Mm-hmm. So a Biden victory, taking the presidency, and then also winning back the Senate so that the Democrats have full control of Congress.
Right. What effect will that have on the markets?
Yeah, so I think this year, the markets are looking at this event quite differently. And basically, the pandemic has changed the market's focus. So in a typical election cycle, markets generally view a divided Congress quite positively, because that really ensures that any policy that the next administration can pass tends to stay relatively close to the center ground. Mm-hmm. Whether it's a right-leaning administration, whether it's a left-leaning administration, you can't stray too far away from the center ground because they don't have full control of Congress. Mm-hmm. This year, I think the market's looking at it quite differently, right, because the most pressing issue this year, given what's going on with the pandemic, is that you get a decisive outcome that unlocks near-term fiscal stimulus. Mm-hmm. That's the biggest issue for investors today, that they want fiscal stimulus to come quickly to give that support to the US economy. Mm-hmm. And therefore, for me, I think the market is most hoping for a clean-cut election, right, and frankly, one where you have Congress on the side of the administration to pass through that kind of near-term stimulus. So that, I think, is what the market is most hoping for. And therefore, if you get that scenario of a Democratic sweep, I think that should provide some support for risk assets. I think that investors will generally view that as quite positively, because those near-term benefits from quick stimulus would outweigh, in the short term, some of those sort of further out concerns about the potentials for changes to tax policy and some of the regulatory issues that the Democrats are also focused on.
Yeah. Focusing upon the Democrats and the so-called blue wave, are there any specific sectors that will be direct beneficiaries of that outcome?
Yeah, so one example there would be renewable energy. The Democrats have been pushing a heavy sort of climate agenda as part of their campaign, very focused on this transition away from traditional fossil fuels and into the renewable energy sector. I think the challenge with all of these things is trying to work out how far the markets have already moved in advance of the event, because as we've discussed, the polls have already moved to suggest that the Democrats are in strong shape. And therefore, we've already seen some pretty big moves in sectors such as renewable energy starting to factor in what the market thinks might be going to happen. Yeah. I guess another sector to look at would be healthcare. And this one's quite interesting, because if you look back over time, generally healthcare tends to struggle in the run-up to an election. It's always in the crosshairs of some form of policy change. And typically, once you get past election day, on average, you tend to see the healthcare sector doing a bit better, frankly, regardless of the election outcome, just because you take away some of that uncertainty. Mm-hmm. And I think we could be setting up for a similar scenario this time round, where, yes, Joe Biden is looking at making some changes to healthcare policy, but they're much more moderate than some of the more left-leaning candidates had been proposing earlier in the year. And therefore, you give that sector some clarity on the direction of travel, and I think that could be supportive as well.
How will the US-China trade tensions be affected with a Democratic win? I'm assuming that it would be a more positive outcome on that front.
Yeah, I think you can break this down really into two different pieces. So the first thing to say is that we think US-China tensions are going to stay elevated regardless of the election outcome for several years to come. Because this idea that the US administration, whoever's in charge, wants to really sort of change the balance of power within that relationship is going to be a consistent theme over the coming years. So I think the direction of travel, the goal from the next administration will look fairly similar, regardless of whether it's a Democrat White House or a Republican White House. Where we do think there could be a difference is in the approach that that administration takes. So whereas President Trump has favored to focus his negotiations in quite an independent fashion, he's liked to do things one-on-one, US versus China, the Democrats are talking about a much more multilateral approach, one in which they will work with other countries or regions to form coalitions to then take on some of the perceived injustices with Chinese policy. And so for the market, that means that whilst, as I say, the direction of travel might be similar, under a Democrat victory, I think there you would have a more predictable, a slower moving approach. And therefore that should sort of provide a bit of relief for some of the emerging market regions, particularly North Asia, that have really been squeezed by the trade tensions over the past couple of years.
There's been a lot of talk about the number of voters that have already cast their ballot. And you've already mentioned a clean, decisive victory. Ultimately, either way, will be received well by the market. There's been talk recently about whether or not there will be a peaceful handover of power if we get in a situation where there hasn't been a very much a clear-cut result like we saw in 2016. If it does get a bit messy, how will the markets react?
Yeah, so there are a few pieces of this puzzle. I think simply the fact that many people are voting this year by mail, voting in a different way to the way in which they cast their vote normally, increases the probability that you get a delayed outcome, no matter how tight that ends up actually being. So I think investors are right to be thinking through the different scenarios as to whether or not markets could very feasibly be opening up on November the 4th with the election outcome still unknown. If it ends up being tight, generally, I don't think that's helpful for risk assets. That uncertainty that normally would dissipate on election day, given that in any election cycle, normally you get to the day itself, and from then on, you get clarity, at least in some direction. I think a delayed result would be the worst outcome for risk assets. Also, you think about the prospects for that stimulus that we know is so important for the US economy. And if you get a period of a couple of weeks or maybe even up to a month of gridlock where Washington is just totally absorbed by simply trying to work out what's going to happen, then that has to scale back any expectations then you can get stimulus coming through quickly after the election. So I think that scenario really is one of higher market volatility, not necessarily a clear direction to that volatility, but one in which risk assets broadly are just struggling a bit to deal with the elevated uncertainty that, as I say, you would hope would normally start to dissipate on election day itself.
Will there be any outcome that could provide a catalyst from the current surge in growth and tech stocks to the more cyclical, value-oriented stocks that have so underperformed over the last few years?
Of course, so I think there is that outcome, and I think that comes down primarily to the composition of Congress. Because if you get that united government and Congress, you get a sweep scenario from the election, then you have the near-term stimulus on the table. That should be positive for the US growth outlook.
Yeah.
And I think depending on the next administration's ability to spend is also going to have an influence on the bond market. We see that generally, if you get a clean sweep, it's much easier for the US administration to rapidly ramp up spending.
Yeah.
And so take that scenario where you have a US government really with their foot on the accelerator, trying to get growth going. That then, I think, could start to put some upward pressure on government bond yields. We've seen that happening over the past couple of weeks as the polls have sort of started to widen. The market's seen an increased likelihood of a sweep scenario. You've seen that upward pressure on Treasury yields. Rising bond yields generally are supportive of value for two reasons. Firstly, they start to make the profitability outlook for sectors such as financials look a bit more attractive. And we know that financials are a big part of the value index. You can also think about this from the other side and say, well, growth valuations have been absolutely turbocharged by the decline in interest rates and by the decline in bond yields so far this year.
Yeah.
And so if you start to reverse some of that, then I think you start to call into question some of those very elevated valuations on growth stocks, and you start to improve the outlook for profitability for sectors such as financials. So I think you can see those pieces of the puzzle coming together. Timing that is very hard. As I say, we don't know what the outcome is going to be. And there are going to be other factors at play, such as news on the vaccine trials that could come at some point soon as well. But you can start to piece together how that catalyst for a value rotation might be there.
Okay. Well, time will tell. We'll have to wait and see, and hopefully we'll get a clear-cut result. Hopefully we'll find out sooner rather than later. Hopefully it doesn't drag on, but whatever the result, it's going to be interesting. Hugh, thank you once again for spending the time. It's been an absolute pleasure, and I'm sure we'll catch up soon.
Thank you.